Hey everyone, welcome back to Corporate Decoder, the place where we dive into corporate filings and try to make sense of it all. This time around, we're looking at Appian's latest quarterly report, and let me tell you, there are some interesting swings and shifts in their numbers that paint a pretty clear picture of where they're heading. Before we dive too deep, if you enjoy getting the real scoop behind company financials without all the jargon, make sure you hit that subscribe button. And hey, we've got a fantastic community over on Discord where we break down these filings even further. So join us there too, the link is in the description. Okay, let's get right into it. The first thing that usually grabs my attention in these reports are the balance sheets, and Appian's for the quarter ending the 30th of September 2025 shows a few things worth noting. Their total assets are down slightly from the end of last year, sitting at about $611 million. This dip is largely due to managing their current assets, like accounts receivable. Their accounts receivable, which is money customers owe them, decreased from about $195 million at the end of last year to around $172 million as of the 30th of September. That's a good sign, meaning they're collecting payments more efficiently. This also impacts their overall liabilities, which are just over $660 million. Now, let's talk about the engine of the company, revenue. For the 3 months ending the 30th of September, their total revenue was just under $187 million, which is a nice jump from about $154 million in the same period last year. That's a solid 21% increase. The biggest driver of this growth is their subscriptions revenue, which hit about $147 million for the quarter. That's up 20% from last year. This is the lifeblood of a software company like Appian. They also saw good growth in professional services, bringing in around $40 million, up almost 29%. Looking closer at subscriptions, their cloud subscriptions revenue, which is their main offering, brought in over $113 million, a nearly 21% increase. This shows that customers are increasingly opting for their cloud solutions. And get this, their cloud subscriptions revenue retention rate is a stellar 111% as of late September 2025. That means not only are existing customers sticking around, but they're also spending more. That's incredible news for the company's long-term health. Of course, revenue growth comes with costs. Total cost of revenue went up about 22% year over year for the quarter. This is mostly due to higher hosting costs as more people use their cloud services and increased contractor costs for their professional services. But here is the good part, their gross profit, which is what's left after directly paying for the services, stayed strong around 75.8%. This means they're managing their direct costs pretty well even as revenue grows. Now, let's look at how they're spending to get that revenue. Sales and marketing expenses were about $51.9 million. That's a slight increase of 2% from last year. What's interesting here is that while their revenue grew over 21%, their sales and marketing spend only crept up 2% and as a percentage of revenue. It dropped from 33% to 27.8%. This indicates they're becoming more efficient at acquiring customers. Research and development cost them about $40.2 million, a modest 4% increase. They're investing in their platform, which is crucial for staying innovative. As a percentage of revenue, R&D also decreased, showing good control on expenses relative to their growth. General and administrative expenses came in at about $36.4 million, up 5%. This is where costs for running the business outside of direct sales, R&D, and cost of revenue sit. They've seen an increase here primarily due to higher personnel and rent expenses. And the big picture for operations, they reported an operating income of just over $13 million for the quarter. A huge turnaround from a loss of over $7 million in the same quarter last year. This jump is clearly a result of their revenue growth outpacing their expense increases. Digging into the non-operating items, other income net was about negative $1.4 million this quarter, compared to a positive $12.5 million in the same quarter last year. This difference is largely due to foreign currency exchange rates. They actually had gains last year and losses this year. Interest expense was around $5.3 million, down from $6.2 million last year. This is good as they are paying less on their debt, partly due to lower outstanding principal. Income tax expense was about $1.4 million. And the bottom line, their net income for the quarter was $7.8 million, a massive swing from a net loss of $2.1 million last year. This is why efficiency is so important in business. Now let's look at the 9-month period to get a broader view. Total revenue for the first 9 months of 2025 was over $524 million, a 16% increase from the same period in 2024. Subscriptions revenue for the 9 months grew by about 17% to $414 million. Professional services also saw good growth, up nearly 14% to about $110 million. Total cost of revenue for the 9 months increased by about 12%, which is encouraging. This means their gross profit margin improved for the period to 75.6% from 74.6% last year. Sales and marketing expenses actually decreased by 5% for the 9-month period, which is a great sign of efficiency. They spent less on sales and marketing while still growing revenue. As a percentage of revenue, this dropped significantly from 39% to 31.9%. Research and development expenses increased by a modest 2%. General and administrative expenses were slightly down by about 1%. This all led to a much healthier operating income of $1.3 million for the 9 months, compared to a loss of over $65 million last year. Other income, net for the 9 months, swung positively to a gain of almost $24.7 million, compared to a smaller gain of about $5.9 million last year. This big difference is mainly due to foreign currency exchange rate changes. Interest expense decreased by 11% to about $15.9 million. Income tax expense increased to $3.7 million. And the 9-month net income was $6.3 million, a huge improvement from a net loss of nearly $79 million last year. Now let's talk about their non-GAAP numbers, which are often a better way to see the core business performance by removing some one-time or volatile items. Their adjusted EBITDA for the 9 months ended the 30th of September 2025 was a very strong $57 million. That is a massive leap from a negative $967 in the same period last year. This really highlights how much more efficient and profitable their core operations are becoming. For the 3-month period, adjusted EBITDA was over $32 million. A substantial increase from just over $10 million last year. Looking at liquidity, Appian has over $125 million in cash and cash equivalents as of the 30th of September 2025. They also have about $66 million in short-term investments. This gives them a healthy cushion. Their cash flow from operations was positive at $61.7 million for the 9 months, a huge leap from a negative $7 million last year. This shows the business is generating real cash. Financing activities used about $30 million, largely due to debt repayments and stock repurchases. They also repurchased about 326,591 shares in September alone, showing a commitment to returning value to shareholders. Now, a quick mention of the Pegasystems litigation. This has been a long and complex legal battle. The jury initially awarded Appian over $2 billion. The case has seen appeals, and as of late October 2025, the Supreme Court of Virginia agreed to hear Appian's appeal. The outcome is still uncertain, but the company has incurred significant expenses related to this, although they are insured for a portion of it. So, what's my take on all this? Appian seems to be hitting its stride. The revenue growth is solid, and what is really impressive is their improved operational efficiency. They are growing faster than their expenses, which is the sweet spot for any business. The cloud subscription retention rate being over 100% is a fantastic indicator that their customers are not only happy, but also expanding their use of the platform. The main risks I see are the ongoing uncertainty with the Pegasystems litigation, which, while insured to an extent, still carries legal costs and could have an unpredictable outcome. Also, as with any tech company, staying ahead of the competition and continuously innovating is always key. Overall, Appian is demonstrating strong execution in its core business. The transition to profitability and positive cash flow is a very encouraging sign. They are effectively managing their growth and costs. That's our breakdown of Appian's latest filing. What do you think about these numbers, especially that revenue growth and profitability turnaround? Let me know in the comments below. If you found this analysis valuable, please hit that like button, it really helps the channel. And of course, subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community linked in the description. It's a great place to connect and discuss these reports further. Thanks for watching, and we'll see you in the next one.